do it on another night. So I'm going to go ahead and get started. And I really appreciate all of you that are joining me here today. So as usual, I'm going to start with hello, my life with crypto brothers and sisters. Welcome to another Money Monday crypto training, albeit a little bit later than we usually have it. I'm your host, Kelly Sunshall. And today I want to talk about the basics of technical analysis. There's a lot of material to cover, so let's go ahead and get started. Oh, Dale, I'm so glad you got it fixed. Good job. Okay. Before we jump right into all the technical analysis stuff, I want to start with a few trading terms and make sure that we all at least understand a few of them. There's so many I could go over. It was hard to pick which ones that I thought might be the most important, but these are the ones that I thought people might not be as familiar with. So I'm going to jump in. So an exchange is a marketplace allowing buyers and sellers to trade crypto. Believe it or not, I get lots of questions about exchanges. And these exchanges can be centralized like Coinbase or decentralized like Uniswap. Most of you on this call, I'm going to assume, would use a centralized exchange like Coinbase, Binance, Kraken, Bybit. It used to be Bittrex, there used Gemini. There's so many of them out there. Those are all centralized. Doesn't make them good or bad. You just have to understand what it is. It means that that platform controls your money when you send it to them. It's kind of like a bank. When you send money to the bank controls it until they give it back to you. On a centralized exchange, when you send your crypto to there, or if you buy crypto while you're on their exchange with your fiat money, while it's sitting on their exchange, it's technically in their control. Some would say it's their money. I say that, but it's technically in their control until they send it to your wallet. Then it becomes yours and in your control. On a decentralized exchange like Uniswap, they're much more complicated to use than a centralized exchange, but you are 100% in charge of your money and you're in charge of whether you lose it or not. So I'm not going to go into any more detail on those kinds of exchanges. If you have questions, feel free to ask me. So spread. The spread is the difference between what sellers are ready to sell at and what buyers are ready to buy at. The spread is something you'll hear high performance traders talk about a lot. The spread can eat up your profit if the spread is too wide. It's hard to know exactly what the spread is. Well, not really. You can look at the order book and the order book can give you an idea of what the spread is. But I don't want to get into too much high-end detail in this training. So you can always Google some more about spread when it comes to exchanges if you want. I'll talk a little bit more about it here in just a minute. But it's the difference between what a seller's ready to sell at and what a buyer's ready to buy at. And the spread can really hurt you in decentralized exchanges. You got to be real careful. So one thing I can tell you is that the better the liquidity, the more people there are trading on a particular platform or a particular token pair, the more liquidity there is, the better the spread, meaning the smaller the spread. Okay, let's talk about FOMO. I'm sure everybody's heard of FOMO, but I got to bring it up here. FOMO is the fear of missing out. It means chasing a trade by following the crowd without doing any research or having a good reason for jumping into a trade at any particular moment in time. So, I don't think of myself as chasing trades, but I do wait till they've shown me some strength before I jump into them. Just know if you FOMO in, as we say, once the price has gotten like parabolic at the top, you're the exit liquidity for everybody that's already been waiting for that top. So just be careful. Don't jump into a trade unless you have a reason to. All right, let's talk about chart patterns. This is a predefined shape that technicians have historically studied. Traders like to use previous performance statistics to try and predict future price movements. And chart patterns, and we're going to talk about candlesticks in a moment, chart patterns give you some insight into what has happened in the past. And the consensus is that it will help you predict what might happen in the future. All right, let's keep going. Bull or bear market. So bull markets are when prices trend higher over a prolonged period of time, and a bear market is when prices trend lower over a long period of time. If you have a little short pump, like we've had lately, If we just had that little short pump and prior to that it had been bearish or had been flat, I wouldn't say that there's a bull market. But if you look at the charts, you can see that Bitcoin has started its bull run movement clear back in January of this year. That is a long period of time that gets me convinced that we are now in a bull market. So, as I said, we are currently at the beginning of a bull market cycle. Even though it started back in January, because of the nature of this bull market, it does look like it's just at the beginning. And it's at the beginning because there's not a lot of retail investors in there yet. It's mostly institutional investors. You can tell once you learn to read charts and read candlesticks and stuff a little bit more. What was I going to say? It doesn't mean, just because it's been going on for the last almost 12 months doesn't mean it's about to end. But the fact that it has been going on for 12 months shows you that that is the current trend. The trend is up. So the trend is your friend. We've been in a bear market cycle for the prior 3 years before this one started, which I'm calling it that it started right around January. The last big push happened, I believe it happened around the middle of October, and that was more confirmation that we're in a bull market. So this training today is about technical analysis, and specifically it's about candlesticks. So where can you go study charts? There's a few places you can do it for free. You can actually use tradingview.com, which is the one that I like. It works very, very well. It is what most crypto traders use, and a lot of non-crypto traders. There's a lot of people in the stock market and the Forex that use TradingView. They do have a free version and they have a paid version. They have several levels of paid version. I used the free version for many, many years, and it works just fine. You just have to deal with all of their advertisements and stuff that pops up. And once you get tired of dealing with that, you can upgrade to what they call the essential version or the essential subscription. And if you go on a month-to-month basis, right now it's just about $15 a month. I paid for it by the year, and that drops the monthly price down to something like $12 and something. It's pretty reasonable. If you're going to do a lot of trading, you need a good charting service. And it is so powerful that I'm still learning all of its bells and whistles. If you want something that's a little that doesn't give you a bunch of advertising and it's free, you can go to Deck Screener. I believe it's deckscreener.com. You can Google Deck Screener and look up a pair. That's mostly for decentralized platforms, but it's still a way you can go look up Bitcoin or something and see the chart, because they use TradingView on their back end, but they show you the chart in their window, which is called Deck Screener, and it's free, and you can still draw lines, you can still see volume, you can still see candles. So that's something you can check out. So technical analysis with candlesticks. Technical analysis starts and ends with candlesticks. There's a lot of traders that 100% truly believe this. And I truly believe you must have a clear understanding of candlesticks. I have enjoyed candlesticks from the very beginning when I started trading a long time ago. And we use the candlestick chart, we'll say, instead of a line chart, because a simple line chart, it does not show you price movement in a simple image. It doesn't give you things like the open, high, low, and close over a period of time like a candlestick does. So we're going to look at that in just a moment. Candlesticks can also reveal market sentiment. Long tail wicks denote overcoming supply, while long overhead wicks suggest failure to absorb supply. And don't worry if you don't know exactly what that means, you will over time. And this information is crucial for decision making. Apart from price momentum, candlesticks help identify demand and supply zones. I'm not going to get into a lot about these zones in this training, but we'll talk about it at some point. A long tail wick implies bullish demand or buying, while a long overhead wick suggests bearish pressure or selling. And we're going to look at some actual pictures here in a minute, so you'll better understand what I just said. Understanding candlestick patterns is critical to finding entry and exit points when trading. And one of my mentors, who's a multi-millionaire, I do believe, is he almost strictly uses candlesticks and volume when he's shared some of his trading techniques. We looked at market structure, candlesticks, and volume. So I know there's a lot of traders out there that's really all they want to use. I personally need more than just candlesticks and volume. So let's look at some candlesticks. And I don't know if, I left my book in the house. I have a book on candlesticks I wanted to show. It's about, where's the camera? It's about that thick. And it goes over so many different kinds of candlesticks and patterns. And there's a few that I have paid a lot of attention to over the years, and there's a few that I think you should pay attention to as well. It's an unending study, but we're going to start with a basic candle, and then I'm going to explain two important candles, which they're actual candle patterns. But let's first look at the actual structure. Now, this is a training that I just gave to my paid class, my paid members. They got some of this I'm about to share with you is exactly what I just shared with them. So this image that we're looking at, we're going to, you have to pick a time period that your candle is representing. So like you can look at a daily, when you're looking at a daily chart, each one of those candles represents an hour. When you're looking at a monthly chart, each one of those candles represents a month. So you have to pick and choose the right period of time that you're looking at the chart, which will reflect in the candles that you're looking at. To make life easy for me to teach, we are looking at 1 hour candles. And I'm going to assume that the candle that we're looking at on the screen here, that it started at 12 noon and ended at 1 p.m. because a candle represents an open and a close, a high and a low. So you got to decide the time period. So we're going to assume it's an hour. So in this picture here, like I said, the green candle means bullish, okay, means that the price was going up. So we're assuming that this started at 12 noon, which means that the bottom of this box, the price, whatever the price was at 12 noon, this candle started. And on my example here, I'm assuming that whatever token we're looking at here opened at $1. And then in 1 hour, the price closed at 1 p.m. It closed at $2. But during this whole 1 hour period, the price actually moved up. It moved up past $2 and it moved down below $1. So all of this gyration happened within that 1 hour. However, when it finally closed at 1 p.m., the price ended up here creating this green box. So the little part that sticks out the top, most people call that a wick. I call it sometimes a tail. And the part that sticks out the bottom is also called a wick or a tail. And years ago when I studied trading, the candlestick people I studied called these shadows. I don't hear them called shadows much anymore. So a wick or a tail. So now I can't talk. So now on the reddish side over here, this is your bearish candle, which means that the price opened at the top of the box and closed at the bottom of the box. And again, we're looking at just a 1 hour time frame. So in this case, the price opened at $1. During the 1 hour period, the price went up, it went down, it went up, it went down, and it settled at 1 p.m. It closed at 50 cents. So the price closed down. That's why we have a red box. And again, when it pushed up higher, that's an upper wick, and when it pushed lower, that's the lower wick. So in this example, it pushed all the way to $1.50 at the top, but the sellers won out over the buyers, and it pushed the price down, and it during that hour pushed all the way down to 25 cents, and the buyers managed to bring it back up to 50 cents. Now, if you look at candlesticks like by the minute, by the 5 minutes, or by the 10 minutes, which you can really see what's going on in the market with people buying and selling, looking at these candlesticks at different time frames. So that is the basic candlestick structure. If you have any questions about it, feel free to post them in Facebook, and I'll answer to the best of my ability. So here's a look at the hammer pattern. We're going to look at two different patterns. I don't know if I mentioned them up above, but we're going to look at the hammer pattern and we're going to look at the engulfing pattern. So in simple terms, the hammer pattern It's a bottom reversal candle with a short body and a long wick. This can be spotted at potential bottoms. So here's a picture of what it might look like. So here we have a bunch of down days or down hours or down minutes, depending on what time frame you're looking at. Down, 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 a little push up, down, down, down. And then we have this thing that's called a hammer. Now, what you want to look at when you're looking for hammers is the space between the last candle and the hammer is called a gap. And the stronger pattern showing a reversal is when there is more of a gap here. If this hammer was like right up equal to the red candle, or even slightly, the body of it was above here in the middle of it, it's not as telling that it's a reversal. When it gaps down, like you see in this picture, and then takes off with a gap up, no less, that's very, very bullish. So this is a hammer pattern. And I was taught to think about the hammer as hammering out a very solid place to stand on. So I think about a big old giant hammer, literally hammering out, a piece of metal or something that I'm going to stand on. That's the way I like to think of it. Okay, next, one more. Next, let's look at the engulfing candlestick pattern. And this pattern occurs after a move is invalidated because of a sudden price change in the opposite direction by the next candle. So I'm going to first break down the components of this candle, and then we'll look at it specifically. So this is a pattern, and it's a pattern when it involves more than one candle. When you have two or more candles involved, then we call it a candlestick pattern. So here again, as we just talked about in the red candle, we showed that we had a down moment, a down hour. We're going to pretend like these are all hour-long time periods. So in this hour, the price opened at the top of this box, closed at the bottom of the box, and then we had some push up and some push down. So this is a bearish candle. The next hour, the next candle is looked different, very much different. It had a big push upward, but what we want to pay attention here is that gap again. Now, I like the dotted lines here showing the bottom and the top of the open and close of the bearish candle. So this gap lower where the bullish candle started is important. So in order to have an engulfing, you want to have the bottom of our box or the opening price be lower, preferably than even the tail of the bearish candle. There's different schools of thought out there about engulfing candles. Some say it only has to engulf the body. Some say it has to engulf the tails. I say the strongest suggestion of a switch in price movement from down to up, in order to get the most powerful signal, you want your bullish candle to completely engulf the bearish candle, including the wicks. You can still have a price movement change with only engulfing the body, but the most powerful ones must engulf the wick as well. So you can see in this example here, it engulfs the wick. Okay, and then we have a bullish candle that pushes way up above the body as well as the top wick. So what does it say here on this picture? Bullish candle closes above previous candles open, which is here, what we just talked about. This whole bit up here is well above the open or the top of the box of the bearish candle. And the length of the bullish candle engulfs the previous red candle. And the more it engulfs it, the bigger it engulfs it, the more powerful the shift is in this movement. Bullish candle opens at or lower than the previous candle's close. So that tells you two trains of thoughts. It can open at the bottom of the box or the close, or it can open at the tail. I say if it opens at the tail, it's the stronger engulfing pattern. So let's look and see what it looks like in real life. So in real life, you have prices going down, 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 and then you have some bearish candle, and then all of a sudden you have a candle that engulfs the one before it. This is completely engulfing the tail on both ends. That's a bullish reversal signal. Let's look at it on the other end from the top. Prices have been going up. Prices have been going up, been going up, been going up. We have a nice green candle, but then we have an even bigger bearish candle that engulfs both the body and the tail. That's a bearish reversal. So that's all I have for you guys today. It was a little bit longer training. I'm sorry you had to wait so long for it. I appreciate your patience. If anybody has any questions that you want to ask me right now, feel free to post them in the comments and I'll answer them before I leave. Otherwise, I really appreciate you all joining me today. Mastering candlestic analysis and understanding demand and supply zones is the foundation for successful trading. And I'm going to talk more about demand and supply zones later on. So I hope you always stay curious, keep learning, share your thoughts or questions in the comments, either now or later on, and I will certainly get to them. So thanks so much, you guys. I'll see you all next week. Bye for now.